It's okay if others don't join. Yeah, it's going. Okay, sorry, it cut off. Okay, so transactions, you'll hear the word transaction a lot. So what a transaction is anything that happens in a business that affects it economically or financially. So think about this. When you go fill your car up with gas, and you put your card in there, fill your car up. When you're done, you put the pump handle back on there, and it spits out a receipt for you. That's a transaction. So for that store, you gave them money, essentially, and you got gas. So they're in the business of selling stuff. One thing is gas. So a transaction's taking place. But there's millions of those that go on a day. Depending on the size of your business, it could be 2 or 3. If you sell like heavy farm equipment or something like that, you may have 1 or 2 or 3, depending on how large you are, what kind of area you're in. But like a convenience store is going to have hundreds of transactions a day. Every time somebody buys a candy bar, or beer, or a Coke or something, that's a transaction. You're exchanging money for a product, or even if the bug man comes and sprays your house and you pay him on the spot or he gives you a bill, a transaction's taking place. You either give him money or you owe him money, and he's provided a service for you. So all that kind of stuff is transactions. So accounting takes all of those transactions that happen for a period and organizes them into financial statements where managers and bankers and whoever needs to use the information can look at it and tell something about what's going on. To me, that makes more sense than taking the basic inputs and, I don't know, it's just textbooky. I mean, and you need to know it, but it's kind of hard to make sense of if you haven't had any of this before. If I fall, y'all are allowed to laugh. Just come get me if I can't get up. I trip a lot. I don't usually fall. So, okay, thank you. All right, so the whole point of doing accounting and producing financial statements, which are reports, y'all learn what all that is to give information to users. You've got internal users and external users. And y'all should have gone through that, but internal users are people inside the business, the manager, the owner, the board of directors, somebody inside the business that needs to see the stuff. External users are like bankers, or maybe you want to buy, so maybe you want to open a farm equipment store and you want to buy equipment from John Deere. You're going to have to go through an application process with John Deere so that they will sell to you on credit. So, you can order a couple of tractors and, whatever you need, combines or whatever you're going to order for your area. And that will allow them to bill you and give you 30 days to pay. Does that make sense? Okay, so that's a vendor. John Deere would be a vendor to that store. So when you hear me say vendor, that's somebody that the business buys from. So vendors often want financial statements to see if you're stable enough that they're going to allow you to have 30 days to pay them for stuff. I mean, you might be some crook that, sure, send me the equipment. You sell it off and you skip town and they lose their money. Or you may be somebody who's declared bankruptcy 3 or 4 times because that's your game. That's a game you use. And you get the equipment, sell it, and then declare bankruptcy, and they're out. Things like that. They're protecting themselves. So they want to see what your history is. Do you have a good payment history? So that would be more like a credit report. But they want to look at your financial statements. Do you have assets? Do you have a lot of debt? Just things like that. So that's what banks and vendors would look at it for. And then we have the government on there. And the government actually does ask for financial statements from businesses. I had a client, it wasn't my client, it was my friend's client at Horn. I guess it's fine, I won't tell who he is. He was a physician, and he had not been paying his income taxes. And he got in trouble with the IRS for back taxes. So they did an audit, and my friend was able to make an agreement with them that he would pay such and such amount, and then every quarter, I think, he would send them financial statements so they could look at it and see if he's paying enough. Is he paying all he can pay, and that sort of thing. Well, he wouldn't comply, and he wasn't making his payments, which is scary to me because IRS is not going to come knock on your door and seize your stuff right out the gate. They're going to notify you and notify you and notify you, and then if you won't act right, then they froze his checking account and took all his money. Well, this was after he didn't pay time and time again or submit his financial statements and things like that. So, yes, the government might want your financial statements. They might want your financial information. And you can attempt to lie, but they have ways of figuring things out. Ethics. Have y'all had a chance to watch that video yet? No? Okay. Ethics are morals, your moral standards. And ethics are important in accounting because if you are a person preparing accounting reports and you're not ethical, who's going to trust what you're putting out? Nobody. You know, and most of the time you find out after the fact that somebody's unethical after damage has been done and people have been ripped off. But ethics are very important in accounting. They're very important to public accountants who are preparing statements for clients because, you know, otherwise it's not trustworthy material you're preparing and giving out. So it's definitely important. That's a good video. It talks about corporate fraud and whistleblowers and that kind of thing. Whistleblowers are the people who figure out there's some kind of fraud going on, and they go and report it. And usually they're chastised about it by their company or their peers in the company. But somebody's got to do it because it's people like you and me that get ripped off. Y'all ever heard of WorldCom? You have? Y'all need to look it up because to me that's kind of cool. It was a bad situation, but it was Clinton. I mean, it's right here. WorldCom was a huge financial fraud, and it was during a time where there were several that took place right around the same time period. And I mean, WorldCom was bad because Bernie Eggers that started WorldCom, or was the president of WorldCom. He's from I think it's Hazelhurst, Brookhaven. But anyway, he was a basketball coach. Everybody loved him. He was trusted. I'm not positive he knew what was going on, but he ultimately was responsible. And so he went to jail and he died recently. So I think they let him out of jail last couple of weeks or something before he died. But, you know, everybody trusted him, and people around here, you know, in support of the local guy, put all of their retirement investments and everything in WorldCom stock. So they were fudging the books and making some entries that weren't correct because it's like one of those booming things that comes out and it's really hot for a while and then it fizzles. And so they were at the point where it was starting to fizzle and they didn't see it coming. So they had projected, you know, oh, we're going to make this much this quarter. And when the quarter didn't fall out like that, they're like, oh crap, something's got to be wrong on the books. We just did something wrong. Couldn't find it. So they were like, well, let's just report it this way and we'll look for the mistake next quarter. Well, they didn't find the mistake, and it kept snowballing and getting bigger and bigger and bigger until whistleblower Cynthia Cooper, who was their chief financial auditor, I think, she reported it. And I mean, they went belly up, and there are people who lost hundreds of thousands of dollars that had no retirement anymore because all the money they put in their retirement account, they told the people doing it for them, managing it for them, hey, I want to put everything in WorldCom stock. So they went belly up. The stock was worthless. So they had put hundreds of thousands of dollars into the stock, and suddenly it's worth zero.
That's the wrong way. You're not supposed to invest.
No, it's not smart. Don't put all your eggs in one basket. That's what that means. Don't do that. Don't ever invest just in one thing because you think, man, this thing's going to hit it big. Okay, it might, and if it does, fantastic. But don't put everything you've got in it because things like that happen. And there was a lot of people that made a lot of money, and they were fortunate if they sold before the bottom fell out. But older folks, you'll still hear talking about it. I actually worked for the firm that did his personal tax return. So, you know, the man was in good shape. He did well financially until the bottom fell out. I mean, I would look at his financials and say, is that a comma or a period? You know, because the numbers were so large. It was like, I knew it was a comma, but it was like, good grief. So, anyway, it can happen. It can happen to any of us. So just be careful what you're doing. Be careful who you trust. But that's the reason that I say Sarbanes-Oxley. I've heard people say Sarbanes-Oxley, but you can call it SOX. That's that act that was passed to protect people that are buying stock that's traded publicly. So stock that's traded publicly is how you get ownership in a corporation, which y'all may or may not have read. And publicly traded stock is like you and I can go out and buy Nike stock if we had enough money and felt like it today. You know, we could go get us an account and buy some stock. You know, they're a publicly traded company. Not every corporation is going to be publicly traded. My grandparents had a business, a family business that was a corporation, and they owned all the stock. It was a closely held nightmare. But anyway, that's what that act was for. They set up this board, and they made rules, and so corporations have to do all this reporting, and it's to protect us as investors from getting screwed, you know, and losing everything we've got. So that's what that is for. You probably read, if you read, I know y'all aren't reading. It's not going to hurt my feelings. So if you don't do your work, it's going to hurt your grade. But I know that I hate reading, and that's why I kind of did this thing, just to kind of help y'all focus as you're reading. And you know the book will read to you, right? If you're a better listener and you'd rather write as you listen. I get it. It's just that there's so much information that you've got to know, especially in these first 4 chapters. And like I told the Monday class, I may have in another class. This class builds on itself. So you need to stay with it, because everything we learn, Will can attest to that. Everything builds. So if you kind of get behind anywhere in the front, you're kind of goofing off and not taking it seriously in the beginning, you got to catch up, because you can get left in the dust. The first 4 chapters are foundational, and they all build. The whole class builds on itself. That's the way Accounting 1 works. So don't get behind. It's going to bite you if you do. All right, then GAAP is just the rules that we as accountants use to do accounting. And they're rules that are set up by the Financial Accounting Standards Board. This is kind of stuff you just need to know. You know, it's informational. It's not necessarily going to help you do the accounting stuff, but you just need to know it. I put that exhibit on here from your book that shows all these different entities, types of entities. What are their characteristics? And then some examples. All right, proprietorship is owned by one person. And that's what we're going to be using this whole class. Any kind of business we talk about is a one-man, one-woman show. It's going to be a proprietorship. If you have a partnership, it's similar, except you got 2 or more people. It's scary. If you ever decide to go into business, be careful about just doing a strict partnership. You can, they can strap you, your partner can strap you with some stuff, and there's nothing you can do about it. LLC, the one at the bottom, limited liability company, if you're ever going to get into business with a friend or something, form an LLC, because it protects your personal stuff. If you're just in a straight up partnership and your partner's an idiot and he goes out and says, hey man, I took $10,000 out of our bank account and went gambling and I lost it all. There's nothing you can do about it. If he decides, oh, there's this new thing, you know, I don't know, something goofy that's come out that's a new trend or something, and he's decided this is just what your business needs to do, and he doesn't talk to you about it, he can go make a deal with somebody on behalf of the partnership without your permission, and you're stuck with it. If he goes out and takes some clients to dinner, or he or she, I'm picking on he or she, goes out and takes some clients to dinner and has a little too much to drink and is driving the company vehicle and hits somebody, and God forbid they die or they're injured really bad. Well, if they don't get enough money from your insurance policy that your company has, then they'll come after your house and your car and your bank accounts, and you could be left with a cardboard box under a bridge. You know what I'm saying? So you just got to be careful about partnerships. And then corporations are different. They're kind of hard to organize. You don't see as many of those as you used to, but very large companies are going to do that, because that way they can sell stock to the public. That helps them raise money to expand their operations or, you know, put another location in another city, which is expanding, but maybe expand their lines of what they sell. So that's a good way for them to raise money. So you'll see big companies. They got Apple, Ford Motor Credit, Twitter, Google. So anyway, time period concept. Financial reports you're usually going to see done on a monthly, quarterly, or yearly basis. We'll have examples in some of our homework and some of our examples we work where you'll see somebody with a year-end March 31st. Well, that sounded really strange to me when I first started doing this stuff. I was like, the year-end is December 31st. Sometimes. That's a calendar year. It's also, if it's that business's business year, that's their fiscal year. FISCAL, not physical, like. But if a business has like highs and lows, like maybe a ski resort in Colorado, like their highs would be in the cold season, and then when it starts warming up, maybe it drops down, obviously for the skiing part. So when it drops down low, that's when they're going to end their business year, because that gives them plenty of time while things are slow to get their financial reports together and all that sort of thing. So that's called a natural business year. All this is terminology. Just read through it. You'll have quizzes. You'll have a quiz at the end of the chapter that will help you with that kind of stuff that you can take 30 times, and it's a review. That's what it is. Okay. So the first thing in here that we're going to look at as far as an example is the cost concept. And it's common sense, but then again, when they start throwing weird terminology into your problem, it gets confusing. So the cost concept means that whatever you purchase on behalf of the business, we're going to record it at whatever it cost you, whatever you had to borrow from the bank, whatever you had to pay with a check, whatever it cost you if you traded something, whatever it cost you to get that thing, that's what we're going to record it at. It's not necessarily the appraisal amount, or you'll see assessed value. Assessed value has to do with taxes. Ask your parents about that. It's annoying. That's how they calculate your property taxes. An assessed value is never going to be the same amount that you could actually go sell your house for or sell your property for. It's never going to be the same. So don't let assessed value throw you off, or appraised value. It may appraise for something, but is that what you paid for it? What we paid for it is what we need to look at. And that's what our example's about. But real quick, the objectivity concept. That means you don't commingle your personal and your business stuff. You keep your business stuff in your own personal checking account. You, like your light bill and your water bill, you keep it separate from your business stuff. You don't commingle the stuff. That's what that means. No, I'm sorry. That's not right. Objectivity means you can prove it. Oh, crap. Where's that right? I'm sorry. All these concepts, you never hear you never hear them again. So it's, I think that's not right. Did I even put it in here? Maybe not. Okay, scratch that. Objectivity means you have proof, like you have a receipt. You have evidence to prove your purchase price. I'm sorry. I didn't mean to confuse you. Unit of measure just means we measure things in dollars here. I mean, that's kind of common sense. We measure things in dollars as, and money is our common unit of measurement. Okay, so this first one we've got, and I'm going to flip over to our screen. Why are you doing that? Oh, there we go. I don't want that one. I want that one. Okay. All right, so this is your worksheets. I'm still trying to figure out how to get that over. This is not like the one I had on my note, so it's giving me fits. Plus, I'm not the most computer literate person in the world. Okay, so let's get to, and it starts at the bottom. Where are we? No. Y'all bear with me. Some of this smartboard's new to me too, so I'm trying to figure it out, and it doesn't always like me. Okay, cost concept. I don't think I can make this bigger. Yeah, there we go. Can y'all see that okay? Okay, so in this example, you've got a company called Embers Maintenance Service. And they extended an offer of $395 for land. Okay, so what that means is, anybody y'all ever done anything with real estate or have a realtor parent? Real estate parent. So if you want to buy something, a piece of land, a house, even a car, and you extend an offer, that means you're telling them, hey, I'll pay you $395,000 for that piece of land. The sales price that the seller is asking for is $410. They want $410, but you come in and say, or Embers comes in and says, hey, I'll give you $395 for it. And in real estate transactions, you'll see this going back and forth. Offers, counter offers, offers, counter offers. It's not fun when you're in the middle of it. So they ask for $410, the company selling it. And this company, Embers Maintenance, is offering them $395. So on August 20, Embers accepted the seller's counteroffer of $408. So apparently they went in and offered $395, and the seller said, nah, but we'll sell it to you for $408. And they said, okay, sold. Does that make sense? The wording is, this is the thing, I swear, I think sometimes the textbook publishers think, like, take for granted, y'all have heard all this stuff before. Because I'm, counter offer, offer, unless you watch, flip or flop or one of those things. Okay, so on September 15th, month later, the land was assessed at a value of $320,000 for property tax purposes. So I told y'all, ignore that one. Okay, that's fantastic. They're going to pay taxes based on $320,000. That doesn't have anything to do with what you're recording it at. And then on November 5th, Embers that had just bought the land was offered $450 for the land. So what that's telling you is somebody comes in and goes, hey, I want that piece of land. I'll give you $450 for it. Well, what that's telling you is that's the market value. That's what someone's willing to pay you for it. Is that what you pay for it? What did you pay for it?
408.
408. So the answer to that, I went all around the world and I was trying to explain all the terms. Y'all understand where I'm getting on that? 408. I'm going to change that. Okay, so 408,000. That is what would be recorded. And just because a month or two later it's worth 450, that doesn't mean we're going to change it to 450. This is based on cost. We want to record everything at the amount that we either have paid for it on the spot or that we're going to have to pay for it. Okay, accounting equation. All right, so resources that businesses own are assets. Y'all may have already filled this in. I intended for us to do that in here. I'm sorry if y'all struggle with that. Okay, so an asset, and see again, they're getting kind of fancy. Resources owned by a company. Okay, is that your cell phone? Is it worth something to you? And it belongs to you. So it's your asset. And that's a personal level, but just to kind of get you, get the concept. Is that your book bag? Okay, it's your asset, right? Belongs to you. It's worth something to you. And your computer. Those are all assets to y'all. So anything that a company owns that's worth something is an asset. Now, it may become worthless after they've bought it, but if it's something they get, and at the time they get it, it's obviously going to be worth something or they're not going to get it. Cash. Cash is an asset. Accounts receivable. And we'll talk about what that is here in a little bit. Y'all let me know if you can't read my handwriting. Land. I'm just trying to give y'all some examples so y'all know some things that are worth. And basically what I have said, now there are some assets that are considered intangible that you wouldn't necessarily be able to touch. But if the business owns it and you can put your hand on it, think of that as an asset. I mean, land, yes, you can actually go out there and put your finger on it. You may look like an idiot, but you can touch it, And I've had the question asked before, okay, so what if you have a piece of land that you purchased and, you know, you find out that there's toxic waste dumped on it or something. Well, it was worth something when you bought it. So it is your asset. You're probably going to write it off and abandon it because it's nasty, but it still is an asset. It's something that you bought that at the time was worth something. Equipment. That's another one. You might have to buy warehouse equipment. You might have a copy machine in your office, your computer, all that's equipment. All right, so inventory. I know some of these questions I ask y'all may think are so stupid, but not everybody's going to know the answer to it. I just want to make sure you know what it is. I don't take for granted you understand a concept and I've just blown by it. So if you don't understand something, ask me. What the heck does that mean? No stupid questions. I'll make enough of a boob of myself up here that maybe it'll make you comfortable. Because obviously I trip and I forget stuff and everything else. So there's no stupid questions. Inventory. Inventory is just like if you're a store that sells stuff, sells merchandise, your inventory is the stuff on the shelves that you're selling. Walmart's full of it. So what you're selling, because you know a proprietor they can provide services, they can sell stuff. You know, there's more than one type of business, obviously. Okay, and then I put supplies on here. I'm going to go ahead and tell y'all that a little bit down the road, not too far, we're going to have supplies expense as well. When you see just the word supplies, that means supplies that we have on hand that we have not used yet. So it's kind of like your supply closet. It could be your closet with your paper towels and your cleaning products, or it could be your supply closet with your pens and stuff, because you go to Office Depot once every 3 months and you buy a whole bunch of stuff. You're not going to use it all at one time. So when you buy it, you put it in supplies, and then every month we take off what was used. Okay. What's the rights of creditors? Liabilities. All right, liabilities are the rights of creditors, which again, their definitions are kind of formal. That's stuff you owe. That's money you owe. Anybody got a car note? That's a liability for you. And I hate them. I've got one myself. Actually, I've got two. Fun times. Just wait. You'll have one day. Put it off as long as you can. I have a friend at the gym that just got this beautiful new 4Runner. And I was like, oof, I bet the payment on that's bad. And he said, oh, that's like $800 something. Oh. So think about that, because my daughter wants, you know, she's got an 05 4Runner. And she loves it. But, she wants like a nice fancy one. I mean, don't we all? I would like one too. The one parked out on front that kind of got up on the thing, you know, that's the one I want, with the jacked up with big wheels and black rims, and the, you know, that's what I want. Yeah, I like cars. $800 a month, and I think they traded something in, so that wasn't the full price of it.
Nah, 2005 is better.
She loves it. It's a little rattly, but she loves it. We've kind of patched it up. She had an Accord, she killed it.
New stuff just has its tendency to mess up because it's got a lot of electronics in it.
Oh, that's the truth. And remember that all the bells and whistles that you think on there are so cool, that's more crap to break. Keep it simple. The old cars, like back in the 80s, my first car was an 81 Z28 Camaro. But I could like raise the hood and check the oil relatively easily. Now it's like, you know, you got to kind of hunt around and see where your dipstick is, or heaven forbid you have to jump your battery off. I mean, my battery was right there. My car was simple. I mean, it was nice. It was loud and fast and all that kind of stuff, but it was simple. Now, not so much. I mean, BMW charges you $250 just to drive in, if you're out of warranty. All right, that's true. Don't get one of those. I love them though; they're beautiful. We used to get rental cars for traveling when I worked at Moore, and they were nice ones. We had a good deal with Enterprise. I mean, they were only $40 a day, no matter how unlimited mileage. But they would send us these nice cars. I guess they thought that Maybe it was kind of one of those, we'll sell it to you later kind of things, because they do sell their cars. The last one I drove was a 700 series BMW. And I mean, you could literally, like, if you wanted to turn the radio up, do that. I was like, seriously. It was kind of funny. But then when I got back home and had to get back in my Civic, I was like, Suddenly get kind of snobby and don't want to get it. My son's got the Civic now. He loves it though. Cool little car, it just wasn't a 700 series BMW. All right, so examples of liabilities. Accounts payable is one. I don't think you can erase just one thing. All right, notes payable. We'll get to that later, but I'm just kind of trying to give you some examples. Notes payable is like what you owe on your car. That's a notes payable. If you borrow any money from the bank and you're paying on it on a regular basis, you have a monthly payment. That's a note. Wages payable. Salaries payable. That's money you owe your people that work for you. Because what may happen, anybody got a job? Anybody ever worked at a job? Okay. Well, you know how when you start working and you finally get paid, you're getting paid for like 2 weeks ago and back. Because you have a pay period. Maybe it's Sunday to Saturday, or I mean, it's something different for every business. But let's say the month ends on a Wednesday. Well, the business owes its people for, the days that fell before that and that day that the month ends, but it's not payday yet. So they want to show that those wages go with that month. It's not, you're not going to ever have a situation, you shouldn't. You do have them sometimes where they owe the employees and don't pay them on payday. That's a good way to get yourself killed. All right. Rights of owners, it's owner's equity. And that doesn't really tell you a whole lot about it, what it is. If you have a corporation, it's going to be called stockholders' equity. But essentially what that means is, what do you have in the business as an owner? If you took all of your assets, like you've got your cash, but then you've got other stuff, and you sell everything off and you pay off all your debts, what you have left over, that's your equity. If you have a car, for us personally, this is what equity is. Okay, let's say my car is worth $10,000 and I owe $5,000 on it to the bank. Well, I've got $5,000 of equity in it. So that means if I pay it off and sell it, then I get $5,000. Does that make sense? It's just the difference between your assets and your liabilities. Okay, so the accounting equation, this is very, very, very important. This is fundamental. You will use this a ton. If I can get it written up here. Assets equals liabilities plus owner's equity. All right, y'all, this is a simple math equation. So if you have any one of these elements that you don't know the number for, but you have the other two, you can figure it out. Okay, so that is our next example. We have all these different scenarios, and we got to figure out the missing link. So if you look at example 2, and you've got assets of $20,000, and you've got liabilities of $5,000, what would your owner's equity be?
15,000.
Yeah, I mean, in some of this, y'all don't think this is really stupid and simple, but there's a reason. I'm just getting you I ease you in before I dump the building on you. I don't want to throw you in the deep end all at once. Second one, we've got liabilities of 18 and owner's equity of 22. So what's our assets? 40,000. See, I mean, it's easy to do, especially when it's this way. What gets hard is when you have a problem. You're like, what is this supposed to be? 1,000 in equity, 3,000 in assets. What do we owe? 2,000. So your liabilities are 2,000. And bear in mind, assets, it's like a category. Liabilities is a category. Equity is a category. Under assets, you'll have different kinds, like cash, receivables, supplies, and all that kind of thing. Liabilities, it's a category. It's like a type. You'll have accounts payable, notes payable, and then equity is pretty much stands by itself, but these are like types.
Camera, the door is locked where the camera is. She's gonna work on getting the camera out.
That's fine. I mean, I'm using mine for my class and my office anyway. 4. We've got 125 in assets, 50 in liabilities. 75. I mean, this is, I don't want to take for granted it's easy for everybody because we don't all like math. 300,000 in assets, 75, 290 in liabilities. 200 what? Who said that? Is it you?
224,700.
Okay. 224, 710. All right, so we've got 15 in equity, 69.75 in liabilities. Just math. Y'all make sure when you come each time to bring a calculator because you're going to need it for this kind of stupid stuff. It gets more complicated. Okay, so you just add these two up, right? It's 21,975. All right, 6250 in assets, 2760 in liabilities. All right, what I'm gonna do is I'm gonna write the answers up here because I wanna get to the next one before y'all leave. And y'all I'm surely by now you kind of got the gist of this. You're just filling in the blanks. This is where the kind of the simple algebra, I guess it's simple algebra, I don't know. This is one of those instances where it's pretty simple, but you do have to know how to find something. And if y'all ever calculate something and you get a different number, say something because I have been known to make mistakes. Yes, I'm supposed to be the professional, but I'm also a human, so and I'm not afraid to admit when I make mistakes. Fat finger errors is what my chemistry teacher in high school always called them. She hit the wrong button. Okay, this is a different kind of question, same method of finding the answer. Jerry Hauser is the owner and operator of Talent Consulting. At the end of the accounting period, December 31/18, he has assets of 500,000, liabilities of 305. So using your accounting equation, which is assets equals liabilities plus owner's equity, how much is my equity for that first one?
195.
195. Everybody know how to get that? Just take the difference. All right, what about B? Assuming that assets increased by 75 and liabilities increased, whoa, that's not what I was trying to do, by 20. Now what would his equity be? You're going to take your 305 in liabilities and add that 20. So now you got 325 for liabilities. And you're going to add 75 to your assets. You got 575. How much? 250?
Yep.
That's it. Okay, so that's what your homework's going to look like. Is that stuff. You'll have several exercises. Yes, it may be boring, but it's kind of getting you accustomed to the accounting equation. Y'all will understand the method to the madness as we move through. That's what your homework is on. Depending on how far we get Friday, I'm probably going to add the next section of homework on. But I didn't want to just do it all right away, not knowing what our pace was going to be just yet, especially with things like they are. So, y'all are good. Y'all get it? Y'all okay with it? If you get stuck or something, just message me. That Pronto thing's pretty cool. It's like quick messaging. If I'm in the computer, if I'm not, I'm gonna load it on my phone. I just got a new phone, so I'm gonna load the app on my phone. Y'all load the Pronto app on your phone. You can instant message me. You can get on a live streaming thing if we need to. I can share my screen with you if I need to show you how to work something out. I mean, it's cool. It's got all kinds of stuff. Y'all can talk to each other, direct messaging. I had to figure out how to do that. Which
You can click the little circles where it shows you where you can click it, and then there's like a little message bar.
hang on. What now? Oh, I don't know how to do this. Okay, I'm gonna tell me it's not saying record, like it didn't record that. Oh. Okay, it may not have worked. So this may not be a good way for me to do this. It looks like it is, though. Oh, well. Anyway, there's that button with the arrow in it. If you hit that and it makes it like your whole screen, There's all kinds of stuff you can do. There's more commands at the bottom. What were you saying?
So whenever somebody reads something, just like Facebook Messenger, there's
Yeah.
a tag saying that they read it.
Yeah.
A little circle, you can click their circle and there's an option to talk to them.
Right. But if you want to initiate a direct message,
That's what I'm saying.
oh, like with somebody that hasn't messaged you.
That's what I did, like, I didn't talk to my owner, but I accidentally clicked it.
Mm-hmm.
Let's see.
It says it's live.
Hit recording it and see if it will stop thing.
See, look,
No, it's still okay. So we're done now. Hit stop. Thank you. This is why I have young people around me.